Hello and welcome to Thinking Training. My name is Evans and I'll be taking you through this question. We have the BDA April 2023 paper. This is question 21. We are required to compute the following for each of the three scenarios: the net present value and the internal rate of return. The question says, Nuani Limited plans to invest in a 5-year project in the year 2024. However, the information on the project is not reliable. The company will wish to carry out a scenario analysis. The following data is available given three scenarios. The optimistic and pessimistic scenarios reflect the percentage variance from the expected. So maybe the first thing we can do is to capture my values as actual values instead of variances. Call this my answer. Then I'll pick out the labels as given by the examiner. And the scenario labels also as given. Then the expected values. Next thing will be to find my actual values for the optimistic and the pessimistic case. This will be the expected multiplied by 1 plus the variance. And this will be the expected multiplied by 1 plus the variance. Then I can copy all of this down. And these are the values, the percentages are given correctly. I can just copy them across. Next would be to format my values so that they are all consistently formatted. Then I am told inflation rate applies to revenues, direct costs, incremental fixed costs, and working capital. Working capital will be recovered at the end of the project. Revenues and costs arise from year 1. The capital allowance rate is on reducing balance basis. Tax will be applied on the gain or loss on disposal of the asset. Then the weighted average cost of capital for the company is 15%. So we have WACC 15%. So I will need to establish my cash flows. Which will begin with my years from year 0 to year 5. Remember to format your values. Then I'll begin with my cash flows, starting with revenues, direct costs, and fixed costs. So before I fill in my values, I have to figure out my scenarios here. So I'll give each scenario an index number 1, 2, 3. I'll skip a column and validate on the same row a cell here that will allow me to select between the 3 index numbers. I'll go to data. Under the data tools section, I have data validation. I want to allow a list, and the source of this list is the 3 index numbers. Then now I have a drop down from which I can select my numbers 1, 2, and 3. I'll give this a label, scenario selection. Then now I can use this to choose between my various values of the scenario side. I'll use the choose function using this index number, which I lock between value 1, value 2, and value 3. Then I can copy this downwards and make sure they're properly formatted and give them just a bit of extra formatting to make sure that they stand out. So now when we change our scenario from 1 to 2, you notice our values also change. I'll work with scenario 1. My revenue in year 1 is given as 140. This grows at a rate of inflation, so equal previous year multiplied by 1 plus my rate of inflation, which I know, and copy this across. My direct costs equal minus 60 million, which also grows at a rate of inflation, so equal the previous year multiplied by 1 plus my rate of inflation, which I lock. Same thing for my incremental fixed costs equal minus 40 million, which I can then copy. So I'll have to grow this by my rate of inflation 1 plus 5%, which I lock. Then I can copy this across. From here, I need my earnings before tax. The earnings before tax, which will be the sum of all my values. I'm also given the tax rate, so my tax will be equal minus 30%, which I lock, multiplied by my earnings before tax. Then I'll have my earnings after tax, which would be the sum from the previous subtotal. Beyond this, I need to account for my tax benefits. On depreciation, which will require working. So I have working here, working 1, which would be the tax benefits on depreciation. Here we will need our years. From 1 to 5. Then I'll need the balance, note down the depreciation and the balance carried forward, from which I can find the tax benefit on depreciation. So in the past year, the asset was worth its original cost, which in scenario 1 is 100 million. This depreciates at a rate of equal minus capital allowances of 30%, which I lock, multiplied by my balance breakdown, which gives me a balance to carry forward of the sum of the two values, an amount of 70 million. This balance carried forward becomes the balance brought down in the next period, which I can now copy across to fill in the missing values. And so the tax benefit on depreciation will be taxing our depreciation, so equal minus 30%, which I lock, multiplied by my depreciation, which I will then bring to the top of my cash flows of my work. But beyond this, I was told to calculate again on disposal and account for the tax therein. So I'll have to account for my residual value, which initially, or in scenario 1, is a value of 20 million. Compare that with my closing book value, which I have just found as 16.8 million. This indicates that if I dispose, I'll have a gain on disposal of 20 minus 16. This should be subjected to tax at a rate of 30%. So 30% of my gain, so that I can have my after tax gain on disposal. Which would be sum of these two being 2.235 million. Again, I bring this to the top. This gain on disposal will be earned in the final year. Then finally, I have my working capital. So we'll have working 2 in working capital. Again, I need my years. I need my working capital need and the working capital cash flow. So in my first year, I have a working capital requirement of 15 million into the initial working capital. This grows by the rate of inflation, so multiplied by 1 plus. My rate of inflation is 5%, which I lock. Then I can copy this across. Then this is just the need. The cash flow starts from year 0, so the value here will be this blank cell minus the next year value to give me the cash outflows in incremental amounts and then the final cash inflow. Again, I can bring this to the top. Then finally, I'll need my initial investment, which in scenario 1 is equal minus 100, and also attracted a residual value of 20 million. Then we can have our net cash flows being the sum from the previous subtotal then now with my net cash flows I can find my NPV and my IRR. NPV will be given by equal NPV. My rate is my WACC. My values from year 1 to the final year. Then I can include the initial cash flows. My IRR will be equal IRR of all my cash flows. So I have to remember these values are for scenario 1 only. So I'll have to provide a summary that shows the values for each of the scenarios. I'll replicate this here. I'll pick out my scenario labels. Format will work. So I'll copy this, paste them here as values without the formulas. Then go to the top, change to scenario 2, pick the respective values, and paste them here as values. And then finally switch to scenario 3, where I'll copy these values and paste them here as values. So then I can now make my decision. In the expected, the NPV is higher, is positive, the IRR is higher than the cost of capital, so I accept. Same thing in the optimistic case, I accept. And in the pessimistic case, I reject, because the NPV is lower than 0 and the IRR is lower than the cost of capital. And that will have been my required solution. Thank you very much. I'll see you in the next one.